As you start to look at how most go-to-market teams are structured, there's a disproportionate amount of resources and energy is focused on acquiring customers with the assumption that every single customer is a good fit customer and will expand and grow with you over time. One of my favorite axiom was the only reason for churn is either death or divorce, meaning a customer actually went out of business or they were acquired by a third party. What I eventually learned was that actually in most situations a very large percentage of the install base is actually outside of your ideal customer profile. And then what we're seeing as a business, we typically see something about 70% of the install base is outside of ICP and about 80% of the open pipeline is outside of the ICP, which often creates a situation where as a revenue leader, your ability to create predictable and efficient revenue growth becomes severely compromised.
Welcome to the latest episode of the Raise&Exit podcast. And today we have with us the founder and CEO of Align ICP, Dan Sperring. But Dan is coming into his role as a founder and CEO from a slightly different journey, which I think will be really relevant to all founders and business owners that are listening to this podcast. Dan, this may be less about less about what you're doing today and more about why you're doing it. So on that note, I'd love a lengthy explanation of how Align ICP came around and the lessons you learned through multiple exits to go and build this company.
Yeah, no, thank you so much for the introduction, Edgar. Yeah, in terms of my name is Dan Sperring. I'm the founder of Align ICP. We are a SaaS company really focused on helping revenue leaders create more predictable and scalable revenue and therefore companies.
And that's not very important, Dan, for any company that's trying to sell themselves, correct?
Not at all.
Not at all. Okay, good. Yeah. So we're just really having a hypothetical conversation on today's podcast.
Absolutely. Yeah, and this definitely transitions into our origin story. And so back in 2013, I was fortunate to go to work at an early stage software company that created a new category. So we were first to market. We grew incredibly fast. We raised about $100 million in venture funding over the course of that journey. And I was very fortunate to start out as the first strategic account manager, and over time led the account management function and then eventually the customer success function. On my journey, I was asked by our CEO to come up with a detailed plan in terms of how I was going to grow the business. And as a CS leader who owned not only renewals but expansion, I was responsible for over 90% of the revenue within the organization. And as I built a pretty detailed plan, I worked very closely with my partners in the finance team. And what became very clear was really the path to really scale the business really started and ended with customer retention and expansion. Mm-hmm. And a big part of that, as you grow and scale, as you go from 20 to 30 to 40 to $70 million, what happens is a larger percentage of the revenue is in the install base. And your ability to sell your way out of churn becomes next to impossible. And as you start to look at how most go-to-market teams are structured, there's a disproportionate amount of resources and energy is focused on acquiring customers with the assumption that every single customer is a good fit customer and will expand and grow with you over time. So as a customer success leader, one of my favorite axiom was the only reason for churn is it's either death or divorce, meaning a customer actually went out of business or they were acquired by a third party. What I eventually learned was that actually in most situations, a very large percentage of the install base is actually outside of your ideal customer profile. And then what we're seeing as a business, we typically see something about 70% of the install base is outside of ICP and about 80% of the customer of the open pipeline, is outside of the ICP, which often creates a situation where as a revenue leader, your ability to create predictable and efficient revenue growth becomes severely compromised because you're not really measuring the quality of the pipeline and therefore revenue that you're acquiring with every dollar of sales and marketing spend.
Dan, there's so much that you just went in and said in there, which I think is I think just like a cheat list for everybody listening to this podcast of like the top 3 mistakes that you can go and make, right? One, assume that your churn is only because of death or divorce versus bad experience, loss of relevance, pricing, etc. Right? I think the other element that you go on and talk to is that, oh, we just got to go and win anybody we want, right? Like a big factor that I try and look at in companies that I go and work with is what's your cost allocation or budget allocation towards acquisition versus retention versus expansion. And to your point, the acquisition is so critical. So that's one of the first things that I want to dive into you deeper with, because I think it's so relevant for our listeners. How does a founder kind of lead that sales design when they're still a founder-led sales organization versus when do you start shifting over to a sales leader like you've had the experience of doing? Let's start with that conversation, because I think there's not enough written about it. There's lots of kind of like heuristics, but I'd love to kind of get a sense from you. How does a founder know what they have to systematize versus when they hand off to another?
Yeah. And so on this topic, the best, I'll call it research, and I might be a little bit generous on using the term research, but the best body of work related to this topic that I've found, Edgar, comes from Mark Roberge, the founding CRO of HubSpot. And he published a book. It's called The Science of Scaling. It's an ebook right now. It's coming out in a paper version, or like a full-on. It's moving from just being like a 2-page document. It's coming out in the next few months. But what Mark introduces in his body of work is it's a framework to think about this idea of scaling. Mm-hmm. And it starts with the concept of finding product market fit. And product market fit defined as you have happy customers who renew and expand. You have customers that are giving you strong NPS scores, and ones in which have adopted a key pieces of functionality within your software product. And you could extrapolate that towards other types of domains outside of software. But Mark talks about this idea of first finding product market fit. The next phase is, how do I efficiently go about acquiring net new customers? And the term that he uses is that concept of go-to-market fit. And the metrics that we'd use to define that are things like magic number, LTV to CAC ratios. And the core ideas behind go-to-market fit is, for every dollar I spend in sales and marketing, what type of return am I seeing in ARR? And then according to Mark's framework, once you have product market fit and go-to-market fit, you're finally have reached the stage where you're ready to graduate, and you can start to focus on scale. And so think about this idea of, hey, I'm going to double down and I'm going to hire some sellers, I'm going to hire some marketers, and we're going to start running some campaigns. And then once we scale and moat, or it's the final stages on that journey. So that's the best body of work that I've found on this topic.
I think you've summarized it so well, because I think there's a lot of jargon that we go and have around PMF or LTV to CAC, et cetera, that's in the marketplace today. Because if we look at LTV to CAC, one of the things that I'm a big proponent of is do not look at the average over the average. You need to go and understand what that dissemination is. Like, you need to go and get to a component understanding of acquiring your customers. Like, one of my favorite ones that I went and saw was a company that, like, you did a bit of an audit, you had to put some effort into it, but you discovered it cost you $40,000 to go and acquire a 10,000 ARR customer. Meaning that the payback period was that they had to renew multiple times before you break even. Right. Yeah. So that I think is an interesting aspect of it. But I want to kind of add to another piece of nuance that you went and had, which is around the retention element of it. One thing that I notice in a lot of the valuation side of the work that I'm involved in is there's so much kind of easy reference to revenue multiples or EBITDA multiples, but the companies that get the real premiums on those revenue and EBITDA multiples are the ones that actually have really good retention, like very good NRR, very good expansion, almost like a want from their customers to bring in other feature function, bolt-on acquisitions, etc. From your experience of being as part of a high growth company, seeing both sides of growth, what are the signals or the clues that founders or business owners should be looking for that is a sign of good NRR, and what is a sign of bad NRR?
Yeah, gosh, I've lived this firsthand and go really, really deep on this. So, a couple of really interesting stories. The first one is at a company I worked at. We were in a very, very kind of white hot space, and we were first to market, and we had to create our own licensing model. And so there was never a licensing model created before that was relevant to this type of problem that we were solving. And what eventually happened is, as more and more people started, as the licensing counts grew dramatically over time, what happened was customers weren't getting the relative value. So think about under that concept of, hey, as I have a marginal user, is the value I'm getting from your software growing at that same rate? And what we saw happen was right around about, say, 25 million ARR, we found ourselves with a pretty major churn problem. And as we peel back the onion to better understand why, one of the reports that I created illustrated that we had customers that were around for around 3 years who had grown their licensing, like their monthly recurring revenue by like 1,200%. And as you can imagine, those customers were finding themselves in a situation where they weren't seeing the marginal value associated with that 1,200% increase. And that, believe it or not, the strong net revenue retention was actually creating massive amounts of churn, which is kind of a weird way to think about it. And so things that, like, if you're a founder, or for example, any type of revenue leader, and you're thinking a lot about revenue and how do I make it more stable? The flip side, and this is where the beauty of Mark Roberge and his work related to product market fit, there is a lot of different ways in which you can measure and really understand the strength of your product market fit. And more importantly, what percentage of your customer base is happy. And the three things that come to mind is, and I've seen this time and time again, is this concept of referenceability, meaning what percentage of your customer base would be open to a reference. And what I've seen time and time again is it's usually, in most of the companies I've worked at, it's a relatively small percentage of the customer base, like less than 10%. So you got a situation where you have 1,800 customers, and in 180 referenceable customers seems like a lot, but as you start to think about all the different requests that you would get through, for example, analysts, investors, the sales team who, is trying to close a deal with a similar type of account, I'd argue you want to have a very high percentage of your customers that would be willing to be a reference. That's one thing. The next thing I would look at is think about your customer advisory board. And if you don't have one, it's a great thing where you take some of your top customers from different segments of your business, and you have them come into your organization a few times a year, like ideally at like a kickoff, and talk about how they're using your product. And what you want to start to do is find these kind of different use cases that are really associated with high value customers. And then going back to this other idea related to, is it strong NRR? I think the third one would be thinking about the concept of inbound and asking yourself what percentages of those are coming in from different like sites, like G2 and other places where people are reviewing our technology.
There's just taking like notes on the side here because I'm just like leaning into this piece because look, I hate means, averages, sums as like the sole point of reference to going and making business decisions. And we got introduced to each other, Dan, through a mutual public appreciation for segmentation and understanding the kind of the composition of who buys and why. When should companies start building out that internal segmentation model, like almost like the ground rules for ICP definition. So instead of going and saying aspirational ICP, which is, oh yeah, I want like, the Fortune 500 to buy from me. That's great. But like, what is that ground rules? Like, when should that be building? What level of sophistication do you need to have as a business? What volume of prospects, customers? Like, when do you build out that groundwork for ICP?
Yeah, and so, I mean, a couple different things to say on this topic. So, my belief is that the concept of early stage companies, early stage meaning, I'll call it, it's an arbitrary number, but let's say less than $1 million in ARR. You think about your ICPs as more of it's a hypothesis and one that we're going to continue to test. There's some pretty amazing work done by, I'm a huge kind of zealot of the HubSpot team and how they thought about this topic. And when you study their journey, there's an amazing story where they were building the company, and I think they were, my numbers may be slightly off, but they're right around $5 million of ARR. And they were growing, but not at the rate in which they wanted or expected. And there's a tool called like investment. It's a market investment map. And the core idea behind it is to think a little bit more about personas and asking yourselves, of the use cases our product or service solves, how would this persona evaluate or rank these different features that tie back to use cases? And what's a pretty fascinating story that most people aren't very familiar with is with HubSpot, they were really stuck between two personas. One was, they referred to her as Mary, the marketer, and then they had Ollie, the business owner. And as they were choosing to figure out what to build, and they kind of felt this internal contention within their organization. And even on their homepage, they used to have an option for either persona. What they found was that their messaging and their whole go-to-market strategy was compromised because they couldn't be all things to all people. And what they ended up doing was using this market mapping template, which I use today. And they did a lot of customer discovery and asking, and what they learned was the right combination for Mary, the marketer, that included landing pages, were getting fives time and time again. And then they actually doubled down on Mary, the marketer, and HubSpot's growth exploded. The fascinating thing that most people are not aware of is that Ollie, the small business owner, that was a really interesting market as well. And one that a market that eventually got taken by Spotify.
Yeah.
Or, I'm sorry.
Shopify. Yeah.
Yeah, excuse me. And so what was interesting is on the HubSpot journey, they're sitting between two massive market opportunities and struggling because they were trying to be all things to all people. And as soon as they doubled down, their growth exploded. So going back to your initial question in terms of at what point should founders be thinking about ICPs and product market fit, what I would say is when you have, one of the challenges as a startup founder is you're constantly looking for signal in small data sets. And so I would argue it's incumbent on you to create those data sets so that you can start to interpret the signals that are in front of you. And so taking this construct of product market fit, and then we've also taken another one called message market fit. What we end up doing is, so think about your open pipeline, thinking about this idea of doing some scoring with your open pipeline where you're looking for pattern matching. And so, if you're like most companies, you're probably closing 10% of your open pipeline. And so spend a lot of time analyzing and looking for patterns in your open pipeline. But I'd argue equally important, and probably more important at this stage, sub 1 million, is really thinking about, of your existing customers, which ones are renewing, which ones are opening up lots of trouble tickets, which ones are willing to be a reference, not only for potential new customers, but also, on your website, which ones are willing to talk to analysts like Forrester or Gartner. But I'd argue it's incumbent on you to create that data set so you can start to find that signal.
I love the notion of looking for signal in small data sets, because that to me, I think, is that composition of going and using the hybrid of quantitative, data-driven insights while being also responsible to the innovation or intelligence or creativity that you've brought into the business that you're going and building. There's something also, you've been referring to HubSpot with just great eloquence through this. And what it also reminded me of is what I call like false market signal, where you go and see a lot of industry coverage, whether it's business media, sector media, analyst coverage, whatever it is, and they actually cover a very small set of the use cases because of profile. I was speaking with a former client a number of years ago, and they, in their space, they went and said, do you know that 92% of the startups in our space only go for enterprise? And I was like, wow, right? And so there's this high concentration of people constantly going after it. So what it made me realize, and I'd love your perspective on this, Dan, is I think it's important for you to figure out who you emulate as a growth strategy, right? Do you go and emulate a Salesforce, which went enterprise first, or do you go and emulate a HubSpot, which went persona first? Like I'm reminded of Klaviyo, which, started SMB first. They didn't go into enterprise, and they actually had a lot of struggles with that. So I'd love to kind of get your perspective on what I've just said there from your experience in industry.
Yeah. And so from my perspective on this topic, there's a couple different dimensions that come to mind first. One is, the first one, I'll probably start out with this concept of value chains. And what I mean by that, and this comes out in all of our client work, and it's very, very clear to us. And so as a general rule of thumb, as you go up market into the larger enterprises, what happens is those companies tend to have very, very complex technology ecosystems that they use to execute things like go-to-market, or could be the production of some widgets, but there's a very, very complex tech stack that's already in place. And because of that, those companies tend to like to purchase items that are very, very specific point solutions to fit into those ecosystems. And as you go down market and as you sell into more SMBs, what happens is those companies like a one-stop shop type of solution. And the best, maybe analogous market to look at that most people are very familiar with is CRM. So think about Salesforce, where they have an app exchange and they have a very open framework. And the core idea is you buy their CRM, and then there's tens of thousands of partners that can integrate into their option or into their CRM. Whereas HubSpot tends to be a closed system that includes not only the CRM, but it also includes marketing automation. And as a result, you have these foundationally different strategies for these different layers of the market. So as a founder and someone on the hook for really growing the business, I'd ask myself, with my solution that I'm bringing to market, are we a single layer, or do we have like 5 or 6 layers on our stack? And I'd use that as a guiding principle to determine where in the market I'm best positioned to win.
Oh man, I just love it. I just smiled halfway through what you're saying there, Dan, because what I went and realized is I think an under thought discussion inside organizations is who else is our customer's vendor, right? Like I do a lot of work with our clients in our winnable addressable market work, where we're like what's the tech stack of those who buy from you versus the ones who buy from your competition? Like that sometimes is like huge signal for salespeople, right? Like I remember doing work in healthcare for a bunch of health tech companies and helping them understand, it's like, listen, like, if you're trying to sell to a medical professional in your space that's over 55 years old and has got a large clinic, they're probably not going to buy from you. But the one down the street who's 35 years old, who's trying to differentiate themselves to the same patient base, they will. And here's why, right? So I think it's kind of like, what else do they buy, I think is really, really critical. So that's kind of what I'm having as a takeaway from you here. I want to weave back to something just like from the very beginning of our conversation around this topic, which I think is I, I could say so much more about this, so I think we'll just have the one answer on this. When you go and talk about the notion of the happy customer and the strong customer,
Mm-hmm.
how do you understand and manage the risk of your customers outgrowing you? Because that was something that you went and shared as part of that discussion, right? Your
Mm-hmm.
customers can outgrow you. So it's not just death or divorce. It could be, a happy departure, right? If we add another D to the alliteration that's there. How do you
Mm-hmm.
manage that as a business? And do you just accept it? Or do you actually take it as a sign that you're doing things really well?
Mm. And so the idea of a customer outgrowing, for example, us, I'm thinking through a couple different scenarios, and I think so there's a big part of me, Edgar, that wants to think of like use a specific example to kind of illustrate ideas and frameworks around it. But um, I think as someone on the hook for scaling a business, I think I would start with the question of what percentage of my customer base is outgrowing me. And in some situations, especially if it's a relatively small percent, I'm not sure if it's necessarily a problem. But if it is, something that's dramatically hindering our ability to scale a business, then I have to start to ask myself what's missing from our value chain, and what could we be doing differently so that these companies want to stick with us long term. Going back to your earlier point, the cost of acquiring a customer has never been greater, and right
Mm-hmm.
now, I believe the average CAC payback period is, I think it's north of 38 months. And so when you when you think about kind of the cost of acquiring a customer, ideally we want to keep these companies around like 10 years to really make this a great proposition. But that's not always going to be the case. And there's going to be some very specific markets where, there's always churn. Like every
Yeah.
customer acquire will churn from you.
So I want to move back to a topic that I just really wanted to sidebar on, but this is the
Mhm.
perfect wrap up to our podcast, which is around the payback period and the whole notion of segmentation, right? Like
Mhm.
if you remember, I talked about I don't like the use of averages or sums. So how can one, without great expense and loss of sanity, how can a founder, sales leader, business owner, whatever, go to analyze their CAC and quickly segment it to who is the inexpensive, higher value customer that doesn't cost them too much to acquire versus the painful one that might take you 8 years to recover the cost of?
Mhm. Yeah, and so there's two kind of discrete concepts that we kind of have to tear apart to really answer this question. And so if I were to put more of a CFO hat on, what I say is like, hey, as a CFO, what I'm going to really concern myself with is concepts around customer lifetime value and what's this customer worth to me over the average life cycle of that customer. And so go under that construct, what you will see time and time again is that the performance between segments varies dramatically. When I say dramatically, like 3, 5x. And what happens is because we average the numbers across the business, although that's helpful to report to the board, it does nothing for operators that actually have to grow the business. So the easy button, if you think of, like, especially in the context of SaaS, we have gross margins north of 70%, in the 85%. The easy button is to do really two things. One is focus on net revenue retention because it's a relatively easy thing to get from finance. And then from there, segment just on, I'll call it revenue band, because going back to the HubSpot versus Salesforce example, the market expectations vary dramatically just on size. And then the next dimension in which I would factor in is I would look at verticals. And the reason why I care about verticals is they typically buy for the same use case. So you can use a vertical as a proxy for use cases. And between verticals, which you can probably get from Zoom Info, is probably resident in your CRM, work with your finance team to look at verticals, look at revenue bands and net revenue retention. And that's kind of the easy button to get you what you really are after. if you're more focused on this concept of, hey, how do we really hit our quota targets, I would think of it under a foundationally different construct, which is I would really be looking at things like there's three variables. I take the same segment concepts around revenue bands and verticals. But then what I would do is I throw NRR out the window and I'd look at three metrics. One is days to close as a metric. You easily get out of the CRM with a little bit of massaging. You can also get average deal size. And then finally, you can get a win rate by segment. And what that will help answer a foundationally different question, nothing to do with profitability, but more around pipeline efficiency.
I love that, because what you're pointing to is this is information that you should have. And if you have it, it's an easy segmentation, right? My LTV to CAC by industry, LTV to CAC by price range, LTV to CAC by use case, whatever the heck it may be. And that's what I was kind of trying to allude to. So Dan, thank you so much for introducing us to that and just reinforcing it through today's narrative. And to folks that are listening or watching, go and check out Dan. Hit him up on LinkedIn at Align ICP, Dan Sperring with 2 R's. I don't know what other things I can go and say to send you to Dan, but go to Dan. And that would be the piece that I'd have to go and say. Thank you for joining us today.
Thanks, y'all. Thanks for having me.
Awesome.